Welcome to The Explainer. Today, we're getting into a pretty wild financial maneuver. We're going to break down how you can get cash from your Bitcoin, but without actually selling it. And, this is the kicker, without creating a giant tax bill for yourself. So let's start with a problem that I'm sure a lot of you have thought about. Let's say you're a long-term investor. You've been holding on, and your asset has gone way up in value. But all that wealth is just sitting there. You need some cash, but the last thing you want to do is sell and get hit with a massive capital gains tax. What are your options? Well, in the traditional world, the answer is pretty straightforward. You sell, you get your money, but boom, you also get a tax bill. But then you've got this fascinating new world of decentralized finance, or DeFi, which completely flips the script. Instead of selling, you borrow against your asset. You still get the cash you need, but since a loan isn't income, you get to kick that tax can way down the road. All right, so here's the game plan for today. First, we're going to talk about the core problem this whole thing solves. Then we'll walk through the 3 main steps to pull it off. After that, we'll get into the secret sauce that keeps it from blowing up, something called the power law. Then a really slick trick to make it cheaper. And finally, we're going to talk about the risks because, believe me, this is a powerful tool, but it's not for the faint of heart. First things first, let's really nail down the problem we're trying to solve here. It's all about this challenge that long-term Bitcoin holders, the hodlers, face when they need to access their capital without giving up their position.
See, DeFi just blows up the old way of doing things. As our source material points out, it lets literally anyone, anywhere, use their assets as collateral for a loan. You don't have to ask a bank for permission, you don't have to fill out a bunch of paperwork. It's this permissionless nature that really unlocks the potential for this whole strategy.
So how do you actually do this? Well, it's not just one click. It's really a 3-part dance. A carefully planned maneuver designed to get you cash while keeping your risk and your costs as low as possible. So here it is. Step 1, you lock up your Bitcoin and take out a loan in a stablecoin like USDC, which is basically a digital dollar. Step 2, and this is probably the most important part, you manage your risk by creating a massive safety buffer. And then step 3, you do a little financial judo to make the whole thing way cheaper. Right, that second step, the risk part. This is where the real genius of the strategy lies. It's not just about taking out a loan. It's about doing it in a way that is incredibly safe. And the way they achieve that safety, well, that's the secret sauce. Okay, to get this, we have to quickly talk about something called the loan-to-value ratio, or LTV. It's super simple, really. It's just how much you borrowed compared to how much your collateral is worth. So if you have $100,000 in Bitcoin and you borrow $50,000, your LTV is 50%. The higher that number gets, the riskier it is. Now, you'd think that most people would try to borrow as much as they possibly can, right? To maximize their cash. Well, this strategy does the exact opposite. The whole key is to have an aggressively low LTV. You are intentionally taking out way less cash than you could, all in the name of building this huge cushion against a market crash. And this is the magic trick. That safety cushion isn't just a random number. As you can see from this formula, it's all based on something called the power law support level. Now think of this as a sort of historical price floor for Bitcoin, a line that has held up as a bottom for years and years. The entire strategy is engineered to set your liquidation price way below that incredibly strong floor. You're basically making a bet that for you to lose your collateral, the entire long-term price structure of Bitcoin would have to completely and utterly shatter. It's this choice, this sacrifice of getting a bit less cash now in exchange for a ton of safety that, as the source says, transforms a highly risky leverage position into a relatively stable access vehicle. You're swapping maximum leverage for maximum peace of mind. Okay, your loan is now super safe, but you still have to pay interest on it, right? Well, this is where that final, really clever part of the strategy comes into play. A neat little trick to make this whole thing as affordable as possible. It's actually brilliantly simple. You take those stablecoins, that digital cash you just borrowed, and you immediately turn around and lend them out in a different DeFi protocol to start earning interest. So, in a way, your debt is now generating its own income. Now, the goal here isn't really to make a profit. It's about getting the interest you're earning to cancel out, or at least reduce the interest you're paying. This little loop can act like a massive discount coupon on your loan, potentially making it incredibly cheap, or maybe even free, to access your cash. Now, we've talked about how smart and robust this design is, but we absolutely have to get serious for a moment. This is not risk-free. It's not a magic money tree. This is a high-stakes financial tool, and there are very real ways it can go wrong. Okay, let's break them down. First, smart contract risk. You're trusting lines of code, and if there's a bug or a hack in either of the platforms you're using, poof, your funds could be gone. Second, market risk. That power law model we love, it's based on history. A true black swan event, something nobody sees coming, could smash right through it and trigger a liquidation. And finally, interest rate volatility. If the rate you pay on your loan suddenly spikes higher than the rate you're earning, that cheap loan can get very expensive very fast.
So the big takeaway here is pretty clear. This is not a strategy for beginners. Full stop. It's a powerful, mature application of DeFi, but it's really meant for experienced users who truly understand how this technology works and, just as importantly, how to manage the risks that come with leverage.
So, we end on this question. On one hand, you have this incredibly elegant way to get cash from your assets without selling and without paying taxes right now. On the other hand, to get it, you have to trade the known risk of taxes for a whole new set of complex, technical risks. The real question is, for you, is that reward worth the risk?